that nominal interest rates are double what they were a year ago disguises the fact that those same interest rates are still negative.
Mm-hmm.
The U.S. 10-year Treasury yields 4 in a currency that the Congressional Budget Office, not some cranky old bald libertarian named Rick Rule, says is depreciating by 9% compounded. What that means is, despite a doubling in the nominal yield, the real yield is still -5 compounded. Think about an instrument that takes 5% of your purchasing power away every year for 10 years. Think about how attractive that might be. The irony of it is that the U.S. Treasury market and the U.S. dollar, despite its obvious arithmetic challenges, is the strongest major currency in the world. I would argue, David, that this isn't so much a function of the strength of the U.S. economy or U.S. political leadership, but rather the fact that we're competing in a horse race against a bunch of other horses that are completely lame. The irony, I guess, is that the global outlook to some investors is so gloomy that they would prefer to lose 5% in U.S. Treasuries than lose 15 or 20% in other debt instruments or in equities. That in and of itself is fairly scary to me. Now, I'm not a doom and gloomer, but I do think that we have fashioned some economic circumstances over the last 40 years that need to be unwound. And I think that unwinding will unfortunately be very interesting in a negative sense for an awful lot of people, hopefully not you and I.
And that unwinding is going to take longer than most people think.
I suspect that's correct. Let's, just for fun, we talked about arithmetic in the last answer. Let's look at the arithmetic around a reversion to mean in interest rates. If you look at American interest rates over the last 40 years, the mean condition has been a positive real yield, which is to say that savers have expected a real return after inflation on their debt and deposit instruments. With inflation in the United States running at 8.9, that would suggest that a reversion to mean would have the 10-year Treasury with a 10 handle on it. Traditionally, the U.S. 30-year fixed mortgage has traded at a premium to the U.S. 10-year. Imagine the damage that might be done to American housing markets and to affordability if the 30-year fixed mortgage ran up to, say, 11.
Yeah.
Imagine the traditional premium on revolving consumer debt, credit cards, consumer durables. They have traded at a substantial premium to the 30-year mortgage rate. So imagine the difficulty that American or British households would have if their access to revolving credit was at 20 or 22. You have a situation where a reversion to mean will be very difficult for a lot of people. And the failure to revert to mean means that savers in the Western world will have absolutely no incentive to save. I don't know how you resolve this. I'm interested as opposed to eager to find out.
It's kind of damned if you do and damned if you don't, because at those rates that you're talking about, if you have the 30-year fixed mortgage at 11%, that decimates the property market. Among other things, exactly. Getting real yields back positive is going to decimate the economy also. I mean, it seems like an impossible ask, really, doesn't it? Because I suppose the other thing to throw into that is that, you know, we've got the national debt in the US of over 30 trillion. And if rates go much higher than where they are now, you've got a significant issue when it comes to the interest payments on the national debt, don't you?
I think that's correct. Federal, state, and local governments, remember that the Fed would have you focus on the national debt, the national on-balance sheet debt, which is to say the obligation represented by treasuries. They leave out state and local debt, And importantly, David, and I don't know why they do this, they leave out the net present value of off-balance sheet obligations like Social Security, Medicare, and Medicaid. While there isn't a current interest charge on those, the Congressional Budget Office themselves acknowledges that they're underfunded by about $120 trillion. The way that this works out is not clear to me, but I suspect that you're seeing the beginnings of it in the long-term gilt market in London, where the increasing interest rates and the tightening of short-term credits has meant that some of the largest institutions in the UK are experiencing at once funding shortfalls in their pension obligations and margin calls, to the extent that they were playing the yield curve by buying the long gilt and funding it in short-term credit markets. The turmoil in the London gilt market, I think, tells us something about the challenges that global credit markets are going to face if we have persistently high inflation. The other side of the argument, I guess, is that against all odds, some of what the Fed is doing might work. In other words, they might be able, with gradually increasing interest rates, to slow the rate of inflation to the extent that the rate of inflation itself caused the yields to go positive. If there was a hint that that were going to occur, I've seen no evidence of it, but that doesn't matter. I'm not an economist. If there was a hint that that happened, there is so much cash on the sidelines that you could have a relief rally of whatever duration that would rip your face off. I'm not saying this is going to happen, but there is a lot of money that would like to deploy. And to the extent that it looked like, at least in the US, that the rate of inflation was going to slow enough that we returned to real yields, nominal real yields, as a consequence of the slowing of inflation, rather than the continued increase in interest rates, that could be extremely bullish. It isn't something that I see us being able to accomplish as I look at things, but I really need to disclaim for your audience, I'm an investor, a speculator, and a lender. I'm not an economist, and I look at everything from fairly simple arithmetic base.
Okay, two things there. So what you're basically saying as well is that there is a chance that the Fed will get inflation under control. And if they do that, we can return to positive yields by the inflation rate going down, as well
Correct.
as interest rates going up.
Correct.
We don't necessarily know when that inflection point happens and if they'll actually manage it or not.